Hello, everyone, and thank you for joining us for today's webinar, The Capital Markets Landscape in 2021, a Quarter 3 Deep Dive. This webinar is presented to you in partnership with Refinitiv. You can use the Q&A feature at the bottom of your Zoom toolbar to ask questions. These questions will be monitored and the presenters will answer as many as possible during or after today's presentation. This webinar is being recorded and will be posted on ACG's website along with the slides from today's presentation. Thank you again for joining us. Now I'm going to turn it over to Matthew Toole, Director of Deals Intelligence with Refinitiv.
Thank you very much, and thank you all for joining us today for our Capital Markets in 2021 webinar presented by Deals Intelligence and International Financing Review. My name is Matt Toole, and I head up the Deals Intelligence team within Refinitiv, which is our thought leadership arm of our investment banking business, covering deals across M&A, capital markets, private equity, and venture capital. I'm joined today by Anthony Hughes, who is an assistant editor at IFR, focusing mainly on U.S. equity capital markets. And as we do a couple times a year, we'd like to walk you through some of the key data findings that we see so far as we're heading into year end. Kind of recap some of the key trends within the U.S. capital markets for 2021, and look ahead a bit into what we might expect in 2022. So Anthony, thanks so much for joining me today.
Thanks for having me.
So I think from an overall kind of scene setting perspective, I'll head up with the kind of the headline number. And we've been following these numbers quite closely over the course of the year. But the U.S. equity capital markets have seen over 360 billion in new issuance so far this year, which is up 9% compared to a year ago. And if you look at the chart, this time series chart, over the past 15 years or so, you see a real significant uptick in issuance over the last 2 years. The number of issues also up 18% compared to a year ago. And so, over the course of 2020, with the onset of the pandemic and into this year, we've seen a really resurgent equity capital markets, pace of issuance across all the categories, and we'll dig into each of those as we move through. But it really has been such a broad-based year for investment banking across so many products. But and we'll see that certainly as we round out the year from an overall investment banking fee perspective, where debt, equity, M&A, and even syndicated lending, really having a major place in the world of corporations, governments, sovereigns, and agencies as well. So Anthony, looking at these numbers, you follow some of the details on a week-to-week, month-to-month basis. How would you characterize the year for US ECM?
Yes, it's been an extraordinary year again. I mean, to have a better year than last year, it's quite amazing considering there were some very lumpy transactions last year. I mean, obviously, last year we lost some weeks when at the height of the pandemic, and there was an adjustment period there. But really, this year has been sort of a continuation of very good capital raising conditions, and the backdrop to that has been the stocks have continued to produce some pretty good returns. Now, if you look at the S&P 500, it's up 25% this year. I mean, it's a pretty big move to have after a very good year last year as well. So, I'm not sure everyone at the start of the year would have maybe thought the stocks would have been so strong this year. But, when lots of companies have access to capital, you have a very sort of supportive fiscal and monetary policy backdrop, it just makes capital raising very easy, and people are making money on transactions. Whether that can continue is another question. But maybe the difference this year is that last year I think we saw some really large follow-on offerings that were you could argue somewhat triggered by some corporate reactions to the pandemic to some extent. And then you also had a lot of companies who were actually raising liquidity who were in sectors that were distressed by the pandemic, particularly the travel sector. I think there's been less of that this year, and we've probably seen more opportunistic financing, and it's been a huge year for tech companies. And it's been sort of interesting and a little confusing in some ways, because there has been some periods of volatility and some periods where investors were selling growth stocks, and we saw that recently, and we also saw that earlier this year around March, I think, from memory. But so when you look at the market as a whole, you can see, that stocks have been very strong this year. But when you go below the surface, there have been some certain parts of the market that have actually, have been difficult. And, for instance, the biotech sector has been such a consistent source of both M&A and ECM transactions for many years, and it continued to be a pretty good contributor this year. But if you look at the sector, the indices as a whole, that sector has actually underperformed substantially. So, after there being a lot of paper in the market for that sector, for instance, it's been somewhat it's starting to slow. It's been slowing quite a bit now, and the returns have been quite disappointing. So as we come to sort of the end of the year overall, as we look at the IPO market, really, we're actually seeing a negative return on average from the 2021 class of IPOs. And, I think that must be a little bit disappointing in a year when you've seen so many IPOs. But on the other hand, when you see so much paper in the market, it obviously has an effect on valuations. And we started, we've seen that pull back here in the back part of the year.
And interesting, kind of how you raised, kind of over the course of the last 2 years, just so much kind of corporate finance activity, whether it be, companies that are in distress, opportunistic issuers, people looking to monetize stakes to kind of use that for M&A activities or other details. We saw a lot of that last year, certainly with PNC and others. But then, from an IPO perspective, this new class of issuers, new class of companies, and this here's a look at going back to 2000. So wanted to pull in the U.S. IPO market, the U.S. listed IPO market, and looking at the number of issues listing in the U.S. going back to 2000, when we had kind of so many of the tech names coming in to play. These numbers exclude SPACs as well, totally different category, which we'll talk about down the road. But I think a lot of people felt, and a lot of market watchers felt, that we would never get back to a 400, IPO year, or even a 300 IPO year, because there was a lot of discussions around the dynamics of the U.S. IPO market. Could some of these smaller companies, make their way to the IPO market? Were there enough kind of brokers, underwriters, book runners who are going to be able to support this? This year certainly tells us that that we can see a nearly 400 IPO market in a year, and obviously record levels of proceeds. So from an IPO perspective, you touched on performance being a big driver, but how else do you see the IPO market kind of moving into as I guess as we wrap up this year and as we move into 2022?
Yeah, so interestingly, that chart you have there, as you said, it excludes SPACs, which is another story altogether. But if you were to include that, and then you think about the direct listings, which is obviously excluded from that chart as well, I mean, you can say, A, it's been an extremely busy year, and then B, that the traditional IPO is still, alive and well in a sense. So yes, I mean, we're getting to those sort of numbers, those 2000 levels, which is, prompting a lot of people to wonder whether, this is some sort of peak. And that may be a valid view. The differences between then and now include things like the fact that there's a lot of have to consider like the mix, and sometimes one or two deals do bump up the numbers quite a lot. I mean, the Rivian automotive IPO recently was I think $13 billion with the shoe. I mean, that's just individually just a large transaction, which does push the proceeds number pretty high. But the other thing is when you have seen a lot of technology companies go public this year, and even the consumer companies, which had a big, there were a lot of consumer companies that went public this year because people were essentially betting that there was going to be there was in certain sectors a big bounce in the amount of consumer spending, or there will be on certain types of consumer products and services as we come out of the pandemic. So the whole consumer, the consumer sector was a big part of the mix as well. But I do think, if you look at the big deals, there was a lot of technology companies that went public, and they do, when these companies go public, they sell a pretty small amount of the company. That's one thing that you could be a little bit cynical about, is that a lot of the technology IPOs that I write about, the companies are selling like less than 10% of the company. So in other markets it can be a much larger percentage of outstanding shares. So that contributes to I think you can argue that contributes to supply and demand dynamic, which is very favorable for at least the initial performance of these IPOs. And you can argue when a company sells 10% of itself, then it's not necessarily it's not a big part of the company, but it's an opportunity for them to mark a pretty good valuation. And then if there's excess demand for these companies that are growing typically much faster than the overall economy, then they can create a pretty good supply and demand imbalance that can get them out the door pretty well. But then there's been a lot of I think deep thinking amongst the banks about how they deal with the fact that there definitely has been a lot of IPOs that have done very well out of the gate, but then roll forward a few months, and even less in some cases, that initial pop comes back pretty hard. And I think we've seen that with a few recent IPOs during this sort of more turbulent period in the last month or so. But yes, it's just been a big year for tech IPOs, big year for consumer IPOs, and healthcare has been pretty big too. Just that probably healthcare a bit more problematic than some other areas. But the traditional IPO is sort of alive and well. There's a lot happening behind the scenes though to try to make, I don't know whether you could say, to make the process more efficient. I think there's a bit of a battle on between the structural and cyclical. Structurally, you could argue there's a lot happening to keep the IPO ball rolling, and then maybe cyclically, though, you could say that this doesn't get much better than this. So I think there's a bit of tension between there's still a lot of private capital being raised, which is helping to create a massive pipeline of companies that could go public. But on the other hand, when you have such a big, a large amount of deals, a large amount of paper, it has a market impact. And at the end of the day, there's a lot of IPOs because market valuations are high. And when market valuations are high, there's a lot of incentive for companies to go public. When market valuations are low, there's not so much incentive. So, a lot of the amount of IPOs that happen in a year, 300 plus, I think you've got I think you've got about 400 there, but the ones that we made, maybe there's some smaller ones there, but it's at least, of really sizable $50 million plus IPOs, there's at least 320 odd by my count. And that's a lot. Like, that's, if you take out the weeks when you have holidays and stuff like that, it's something like, I think I worked it out this morning, it's like 6 or 7 IPOs a week, which is a lot for the market to digest, and a lot for, even in a big country like America, to keep the quality high. I think there's been some high quality companies that have gone public, but there's been some that maybe would not have been able to go public without such favorable liquidity conditions.
If we dig in a little bit, obviously, it's not always the company that is looking to necessarily, come to market, but it is their owner. Yes. So looking at kind of the dynamics between sponsors, non-sponsors, obviously Rivian had, some high profile names associated with investment. How much has that had to play this year, where companies are looking to monetize the stake that they've had for whether it be a short amount of time or a longer holding period, but many companies seeing this opportunity, certainly the sponsors seeing opportunity to monetize that investment in a way that might not have been possible last year or previous years. How much is that driving activity this year? And then as you said, capital is still being invested. We're still seeing record levels of of private equity and venture capital being raised. And so, does that continue, or could that, kind of pull back again, depending on different market conditions?
Yes, well, if you look at, just to get to the point about the sponsors monetizing, but if you look at something like Rivian, I mean, it's the biggest IPO of the year, very exciting. It's primary capital. It's in the EV. It's exploiting potentially a huge growth opportunity. I mean, it's a very exciting story. But yes, a large chunk of other IPOs are really driven by people looking to monetize. And when when valuations are high and the liquidity is out there, and people have a lot of money to invest, then there's a lot of the product that's coming through is going to be sponsors looking to monetize assets. And I think one of the big trends this year, which maybe hasn't been remarked upon that much, or maybe in some parts, is that the private equity firms, the big private equity firms, which have been very large participants in ECM, because they use ECM as a way to monetize their investments, and have been very large fee payers on the street. They have several of the large players and have reoriented their portfolio to more higher growth companies. And I think maybe that's happened because historically we think about private equity firms as buying often, not always, but often buying mature assets where they can come in and turn them around and use leverage to supercharge their returns, and then hopefully play a bit of an arbitrage gain and sell at the right time and at a higher valuation. But I think if you look at some of the one of the interesting things this year is Blackstone was behind Bumble, which is the dating app, which is not, it's not a mature company. It's a company that has big ambitions, big growth ambitions. And then Oatly, the oat milk company, that was also backed by Blackstone. That was that's another company that's exploiting a big theoretically growth opportunity. I mean, I think the only thing is that a lot of the sponsor-backed IPOs, and I would think traditionally we'd be talking about like real estate companies or chemical companies or industrial companies that have maybe been around for a long time and are under private equity ownership. But this year we've been talking a lot more about growth companies. But when private equity companies come to sell a company, unlike some other other types of IPOs, they tend to be looking to get maximize price. So one of the problems is that they're very good at timing. They're very sophisticated clients of the banks. So there's always a risk that when they sell, that they're selling at a very good price. And we've seen some underperformance of some of the deals that they have brought to the market. But it's probably somewhat a function of the way they operate. But Oatly, for instance, has been a big disappointment since it went public, and there's been a lot of quite a few stories about some issues with that company. But generally, the private equity firms taking more of a growth orientation has been been very good for them, and they've made some very large returns. And there was another company that went public a few months back there, Olaplex, which is the hair care company, and the backers there, the sponsor backers there, have made some very large returns, and they've been able to do so in a very short space of time. So some of these, I think those three examples I mentioned there are very short holds by the standards of the private equity world. So to make such material, I mean, I'm loath to quote the numbers, but the private equity backers significantly more than doubled their money on some of these investments within a couple of year periods. So that's very good investment, but they're exploiting very good valuations in the IPO market. So whether that's sustainable, I don't know, but that's been obviously one pretty interesting dynamic this year.
It'll be interesting to see. Obviously, we're going to close out the year with over $1 trillion in private equity investments, buyouts. On the M&A side, and the initial investment piece, an all-time record by value and number of deals. So that pipeline is continuing to replenish.
Yes, well,
If we dig in a little bit into also another dynamic, the U.S. versus non-U.S. listing, on New York Stock Exchange and Nasdaq, a lot of headlines around China and Chinese companies coming into the U.S. and some real action happening around that pipeline, and even companies delisting. How do you see the dynamic between U.S. and non-U.S. playing out into the new year?
Yes, well, China really was the source of most of those foreign companies that were listing in the US, and people have a whole lot of theories as to why that was the case and whether that was a good thing. But fundamentally, there was a lot of technology companies from China that were able to access good valuations and ready capital in the US, and investors are ultimately looking for growth opportunities, and China, in recent years was seen as a great opportunity. But the situation has changed substantially this year, as the Chinese government has apparently cracked down on its tech sector and decided to exert more control. And perhaps people are probably writing books about what exactly the Chinese are up to and why they're doing certain things, but it looks like essentially that they wanted to exert more control over their private sector, which is no doubt created many rich Chinese people who perhaps could be very influential people in the country. But I think it was very disappointing and a bit of a disaster for the US IPO market when I think it was in late June that Didi Global went public. I think it was one of the biggest IPOs of the year, a $4 billion plus IPO of basically China's answer to Uber going public in the US. Within days, that stock was trading substantially below where it went public after the Chinese government decided that they would pull the company's app, or they forced the company to pull its app from app stores in China, and have been obviously clearly unhappy that this company decided to go public in the US. And it's raised a whole lot of questions about why the deal ever happened in the first place. But the most recent news on that front was last Friday, when Didi confirmed that it would be delisting the company from the New York Stock Exchange, which is amazing. I think it's 5 months after they went public, something like that, and they're already delisting. And the company went public at 14. When our last look was trading around 8. So anyone who bought the stock at 14 has taken a substantial loss. Really close. Half the. Actually, it was below 8. I think on Friday the low was around 6. So people really lost half their money on that IPO, and the class action lawyers are lining up to find someone to sue. But whether you can sue the Chinese government or the Chinese company is how successfully you would do that is an open question. But it's really just reinforced all the fears about Chinese IPOs that people have been talking about for years, which is what sort of redress US shareholders would have if there's some problem, or whether those Chinese companies can sort of essentially walk away with the money. And really there's not going to be, it's very hard. There are a number of Chinese companies that are on file to go public in the US still, and maybe there is an opportunity for certain companies in certain situations, but it looks like essentially that that trend of Chinese companies going public in the US essentially ended for the time being. And you can talk about this in the context of broader tensions politically between the US and China, and there's no doubt it has there's some truth to that. But essentially, there's not going to be that source of IPOs, and really a lot of those IPOs have been disappointing as well. It's there have been some good companies like obviously Alibaba was the most famous IPO in 2014, but it's come down substantially from its stock price has come down substantially during this period as well. So this recent period, but yes, it just seems like it's not. Yeah. It's a bit of a sad outcome, because if you believe in the globalization of capital markets being quite a good force in promoting world peace, or at least promoting good cooperation between countries. I mean, that was a good trend, but it seems like it's going back the other way now.
Yes, for sure. And also, obviously, many of the American banks who, had quite a book of business and pipeline, we have to kind of reevaluate kind of what that looks like. We talked a little bit about sectors, from a high level perspective. We have technology, healthcare, and industrials, accounting for 70% of overall proceeds. You can see that by number of deals, healthcare accounting for 38%, mostly led by biotech. But interesting to see retail and financials come into play as well. But really very much a pretty kind of concentrated IPO market, where also a lot of companies all companies are becoming tech companies. I mean, in many ways, we have always a good debate around that, but it's certainly interesting to see the dynamic between both the overall proceeds and the number of offerings. Any other sectors that you'd be looking out for, concerned about, or that you've been watching this year?
Well, as I said earlier, the consumer-facing type companies, and that includes retailers, but also a lot of consumer brands. There's been a number of those companies go public this year, whether it's I mentioned Olaplex, and but also companies like Vita Coco and Solo Brands and Honest Company, which makes the diapers. There's been a big pickup in those sorts of companies, but some of those have been a bit disappointing. Because one reason I think is it's just been a little confusing at times in certain situations for people to normalize these companies' performance during the pandemic, because clearly people who made certain brands, or certainly grocery retailers and people like that, had a good pandemic, but how they perform going beyond the pandemic, maybe there has to be some sort of reversion to mean. So I think that has been added sort of a layer of sort of confusion, and maybe some of these companies have been able to get off their IPOs and relatively robustly, but then more recently have come back. And so when these companies are reporting earnings and stuff like that, they're not necessarily producing the beat and raise or that people would hope for to keep the momentum going. But within tech, though, I mean, as you say, I mean, tech healthcare has really been a dominant source of IPOs for many years now. But within tech, I think you'd break it up between software, which is just pretty reliable in terms of fairly straightforward sales. People, high growth companies, recurring revenue. People just like to invest in software companies, generally speaking. There's been e-commerce companies, which there's been sort of proliferation of those. I mean, everyone thinks Amazon dominates the world, but there's been plenty of other e-commerce companies and e-commerce service providers that have been a pretty big feature of this year. And then I think another IPO that was pretty interesting just recently was Global Foundries, which is a semiconductor foundry. Very rare sort of IPO. We don't see those very often in the US, and that was a large company. And it's initially went down, but then it's had a good bounce. But I think with a lot of these companies, that's maybe an example of a company where clearly everyone's talking about chip shortages, and it being quite a favorable environment for companies like that. But then you have to think about with any investment, you need to think about what it's going to be like in a few years. And I think initially maybe there was a little uncertainty as to whether they were just riding a strong cycle, or whether they will continue to benefit from a number of changes to that industry structure there. So I mean, chip making has been sort of traditionally considered a very cyclical industry, but there's a lot of arguments now that chip making is that the business has changed. I mean, there's a lot more chips that go into products that have that are more recurring sales, like smartphones, and then also there's a push on in the US to bring a lot of manufacturing of chips back to America, which goes back to that discussion about China, and it relates to Taiwan as well. But you can see on that list of the big deals this year, there's quite a mix of types of companies. I mean, very strong on the tech side, and but there's also some stuff that's been driven by M&A. I think Vichy Properties was a follow-on that followed their recent merger with MGM Growth, which is consolidation in the casino REIT space, and that was M&A driven. And Clarivate's been a big acquirer. But you've also seen companies come back after IPOs and raise convertible rather than do the standard, straight secondary that some companies have raised convertible when they have very strong share prices, raised convertible, sold convertible bonds. A firm being the one that I would mention there, which is the fifth one down. You can see there's quite a mix there. I think that list there you have there is a mixture of IPOs and secondaries and convertible bonds. But obviously a very high profile IPO this year, which we haven't talked about as well, as Robinhood Markets, which was notable because they had a large proportion of the transaction was much more than normal was set aside for their own users. The mum and, well, we used to call them mum and dad investors, but that's not really a very apt description of the average retail investor these days. It seems to be more a millennial who trades crypto. But that was been a very disappointing IPO. But on the other hand, it's been quite symbolic, I guess, of the fintech having a huge year. So a firm, which is a buy now pay later firm, Robinhood, which is a brokerage, online brokerage, and then you've got this week the Brazilian digital bank New going public. It's quite a large IPO as well. So fintech has definitely been an interesting area. It's pretty fascinating that you have many banks in America, but then we've also got this great wave of fintechs as well. So it's going to be pretty interesting to see how that all shakes out. SoFi, you mentioned there, emerged from a SPAC transaction, and so they're actually a competitor with Robinhood on the brokerage side. But SoFi is obviously historically better known as a P2P lender, but they're basically developing into a broader fintech, offering the whole range of financial services.
Yeah, some very interesting names, that came through the market this year. All very interesting and different stories, and reasons. But certainly the open equity capital markets allowing for many types of transactions and many different pieces of the market being covered here, and overall use of proceeds. If we dig in a little bit to the convertible market, you mentioned some companies coming back with converts. We did see a very strong year last year with many companies tapping the convertible market, much driven by kind of technology and obviously the impetus for a convertible bond is obviously very different depending on your stock price and all that. But we do see still another strong year for converts, a little bit of a decline compared to a year ago, but technology really is still kind of driving the way for 40% of overall issuance. I mean, this market will pull back a bit, do you think, and continue, or how do you see converts kind of shaping up?
Well, we had some periods there where it was very active, really when tech evaluations were very strong. So you did have those opportunistic financings when companies like Peloton, I think back in February or March, they were able to do these zero coupon convertible. It was a very attractive form of financing, zero coupon convertible bond with a very large conversion premium, and then the ability to use a call spread to, defer the dilution to even higher levels. But, you saw the tech, well, I don't know whether you call it the meme stocks, the tech stocks, the growth stocks, the high flyers did get sold off pretty hard around, shortly after that period. So, and then Peloton has had, some pretty, has had a major drawdown of its stock price more recently. And then actually a few weeks ago, they raised, it kind of tells you how companies behave in different environments, but they did a straight equity follow-on stock sale a few weeks ago, primary. So, obviously earlier in the year, they were able to do this extremely attractive security, which was the convertible bond, zero coupon, up, I can't quite remember the number, up, I'm going to say up 50%, say, don't quote me on that number, but, and then roll forward, the stock's gone down significantly. I think they were selling stock here a few weeks ago at 40, I'm going to say, between $40 and $50 a share, whereas the stock was, I can't remember the high, but it was well over $100 a share. But so you could argue that when there's periods of volatility, that convertible bonds are attractive. I just think, though, perhaps convertible bonds will be still be a good opportunity for companies. But if there's tighter liquidity in the next year, then that might be tougher to keep up that pace of activity. I mean, I think the convertible bond bankers would maybe may disagree, but I think this level of activity is not, is historically outside, so it's always difficult to keep it up.
Yeah, no, it's certainly something to continue to watch, and one that's much more sensitive to some of the broader kind of bond kind of conditions and what might be happening in that market. So one of the biggest stories of the year, as we've covered and you've covered certainly, are SPACs, and this chart has now kind of come to kind of a full 12 months of pretty wild swings as far as the number of issues and capital raised. But to see the decline in Q2, after just an unbelievable record-breaking kind of 3 months of issuance, but then also to see a pretty slow kind of resurgence as far as overall capital being listed, and the number not approaching levels that we saw in the beginning of the year, but still a very healthy number of SPACs still going out there and raising capital and looking for combinations. What's your view on this market? There's been a lot of news over even the last 2 or 3 weeks around some of the completed deals or the pending deals that are now being reviewed or restating earnings or dealing with the SEC. Obviously performance and track record has a lot to do in this market, where you can actually prove that you've executed on a transaction well and you're bringing value to the shareholders. What's your take on where we are with SPACs right now?
Yes, I think you summed it up pretty well. I mean, those numbers you can see there in January, February, March, I just don't think they'll be repeated for a very, very long time. But the SPAC bankers we talk to do expect there to be continued activity, and whether you love or hate SPACs, I think it has created a pipeline of M&A transactions. So we're going to see these SPACs that went public in the first quarter of this year. They're going to have to do a deal, at a certain point in time. They have a time horizon. It varies between 18 months to 24 months. Yes, it's been varying a bit lately. But I think it's going to be a substantially lower, reduced amount of activity. The only, the caveat to that is that, yes, if the higher quality sponsors, you can, perhaps define that how you will, but the higher quality sponsors, are going to continue to see it as apparently a valuable funding tool. I think the real concern is that, these numbers here show what we would call the front end being, the IPO. But, I would sort of argue that with a SPAC, it's kind of almost, I don't know whether this is the right way to describe it, but it's almost like a reverse IPO, where I think the real action happens at the back end when you do that merger deal. And essentially, these SPACs find typically a private company and they give them their cash. So essentially that private company is doing that IPO at the back end. But I think a lot of the business combinations or SPAC mergers that have been done, quite a large proportion will be seen to be disappointing, because the companies that go down the SPAC path, a lot of them are companies that younger companies that may be dealing in areas that are fairly speculative. So, there's obviously going to be some sort of like hangover or reckoning, I would say, of some of these deals. And, I think you can already see that the SEC is very concerned, and it's put a number of roadblocks in the way of the sector, of the product to make it more difficult to have this level of activity, where they're obviously concerned that the quality of the companies going public is not as good as it would be through a traditional IPO. But yes, I think with SPACs, there's going to be a number of issues with some of the deals that have been done, and there are still some IPOs getting done, quite a lot, and you could ask yourself, why is that? And one of the reasons is there's been a lot of structural changes to what is now the sort of SPAC IPO that's being priced, and there's a big effort to share the sponsor economics with the investors. So I mean, you could argue that, and I think there's been a number of stories about this, how really by sharing the sponsor economics and even the whole structure of SPAC, where essentially the sponsor, when I say the sponsor economics, it's really the founder shares that go to the sponsor, which are more or less free, which means that the sponsor can essentially make pretty good money out of a SPAC merger without necessarily delivering really good performance. So the stock could ultimately trade below 10, but the sponsor could still make out pretty handily. And I think this is probably underlying a lot of the concern for investors and regulators. But really, at that front end, these deals are still happening because essentially it seems to me that the banks are offering investors who are playing in this field and have cash a pretty low risk low risk opportunity, because they get a share of the sponsor economics, and they're also getting other structural concessions, and they obviously get the ability to get their money back if they don't like the M&A transaction at the end of the day. So I'm not sure that having a lot of SPAC IPOs pricing now is really indicative of a strong SPAC market. In actual fact, the SPAC market's got a lot of challenges at the moment.
Yeah, and it'd be something to watch, certainly. I mean, it's certainly been a huge component of overall M&A, with the activity that we've seen over the course of this year, a bit of a decline. And as you mentioned, a good amount of the M&A happening in some of the kind of non-traditional sectors around, electric vehicles or solar or others. So interesting to see kind of where the market shakes out.
Yes.
If we kind of round out the capital markets, kind of looking at the U.S. corporate debt, we have an all-time record for high yield offerings this year, and a bit of a decline from the investment grade world, which last year was the year of investment grade corporate debt, and so much activity happening in the space. So I think it's certainly a large part of what's happening within investment banking, but a little bit of a decline compared to a year ago. And then the high yield story kind of really having a big impact. Are you able to hear me, Anthony?
Oh yes. Yes. Well, again, it's been outstanding conditions to raise capital, and investors have been looking for places to park money and find better returns. So high yield has been attractive from that standpoint. Again, it's the question of whether these sorts of levels are sustainable, and they can be difficult to sustain if we're going to go into a period of higher rates. But I think people still have pretty robust view of the economy and corporate earnings. So if even rate rises, would it be at least indicative of some confidence that the market can sustain, that the economy can sustain that? So defaults and things like that don't necessarily follow, I guess, if the economy is still growing pretty strongly.
Yeah, most certainly it's a one to watch for next year. And one of the biggest things that we've seen over the course of the last year or so is the kind of the emergence of the sustainable finance market, particularly in the bond world. Green bonds being kind of the most famous product, but sustainability and social bonds, and also seeing a lot of innovation in the space around blue bonds and forest bonds and diversity and inclusion and other uses of proceeds, which have really come to the forefront throughout the pandemic and after. We have seen a pretty marked decline in the number of deals and even the proceeds over the course of the year, but still growing at a substantial clip compared to a year ago. And I think certainly a tool that many bankers are looking at and companies are looking at as well. Investors also demanding potentially some more kind of more product and more issuers here. We've seen a number of inaugural issuers come to market this year with sustainability and social bonds. I think we have seen a couple of kind of green and social converts, but I think from an equity perspective, still a debate as to how you have that the sustainable story or the ESG story make its way into equities or common stock. How do you see this kind of potentially making its way into the ECM world?
Yes, well, I think it's become very common for companies going public, for instance, to highlight their ESG credentials in different ways, but it's becoming almost standard, I think, for a consumer-facing company to do so, because they obviously find it's an attractive selling point, and it's something that potentially may be it's hard to measure, of course, but may be something that could deliver them a higher price and higher valuation than they otherwise might get. But I think we've seen a lot of companies really tout their ESG credentials. I mean, there's been some interesting examples lately. We saw the IPO just last month of Allbirds, which is a maker of sustainable, what they call sustainable shoes, or shoes that are made from natural products. And it's a very successful company, but its IPO was actually delayed by a month or so after it had a bit of a lengthy back and forth with the SEC over some of the disclosures in its filing, and it probably really highlighted that the SEC is a bit concerned about this idea of greenwashing, or the idea that companies might make a lot of ESG claims without necessarily being able to back those up. So I think that's where the SEC is concerned. And we talked before about SPACs, but the SEC is also, I think, a little bit concerned that when we've had this period of excess liquidity and so many deals, that if something goes wrong, they want to make sure that they were can't be accused of being asleep at the wheel. But we also had a new administration, new people at the SEC. But with Allbirds, they just, when in the initial versions of their IPO prospectus, they described their offering as a sustainable public offering, an SPO, which was a new term that we'd never seen before. And it was this term that the SEC had a bit of a problem with, because it isn't really a legal term, and I guess it was unclear exactly what it meant. But it ultimately, Allbirds had to withdraw that terminology and change a lot of the wording of its prospectus. But the SEC was also concerned that when the company talks about like having a very low carbon footprint, or having these targets to reduce their carbon emissions, that they really back that up with all the necessary information. So I guess investors can decide whether that's information, or material information. But there's also just a fine line between what the information that's in some of these filings that's sort of has a marketing type purpose, and what is sort of more the hard facts, the hard financials. And so I think companies who tout their ESG credentials are going to need to be a little bit careful to ensure that any claims that they make are fully backed up.
Yeah, I think that's a huge part of the bond market as well, in kind of displaying the use of proceeds and where that capital went. I think so many inaugural issuers coming to market this year, and when they do want to come back to market again, we'll have to show I think a good amount of transparency as to kind of what what the proceeds were used for, and certainly we've seen a number of banks begin to do that with their large commitments to sustainability, really outlining kind of what they've underwritten and where their lending has gone, and really being very transparent around that. So it'll be interesting to see how that market continues into the new year. So that's all the data that we have. From an overall kind of just closing overall perspective, Anthony, I guess your final take on the year and the things that you'll be looking at as we begin 2022.
Yes, I think we're a sort of interesting juncture here, aren't we? I mean, just today, just the last few days, the market has had a nice rebound as people seem to be less concerned about the Omicron variant of COVID-19, and it's interesting because clearly that's not the only issue that's confronting investors. We also have a FOMC meeting next week where we're going to see the Fed taper, and I think last week the Fed indicated it might be a bit more aggressive on pulling back some of the monetary stimulus the bond purchases that they have been going out throughout the pandemic, but also looking to rate rise. Some of the banks certainly are more bearish than others on next year. I think when you've had a year of 25% returns after a big year last year as well, it's hard to expect the stock market to keep going up. Although, the beauty of the US stock market, it does seem to go up over time. It's just a question of whether there is a significant drawdown at some, maybe more shorter term period. So, but overall, in terms of capital raising, there's just been so many IPOs this year, and the performance has been weak. I think I just looked at it earlier today. The average return of this year's IPOs is actually now negative 3.3. So it's kind of closed the IPO market more or less through the end of the year, although there are a few interesting IPOs, actually there's two software IPOs pricing in the next 2 weeks, which, they're high growth companies and they tend to be pretty well, they're the sort of companies that people are very comfortable with, and they're high growth and they're in the right sector, they're in the right part of the technology complex. And so, they generally like fairly straightforward transaction, and people can be pretty confident that they'll generate some gains once they debut. Although I think just in the past few months, it's been a little bit more unpredictable how some of these companies trade. But some of the bankers we talk to certainly believe there's this golden period of ECM ahead, and that we're reversing these long-term trends in terms of the number of public companies. And clearly, when you have 500 SPACs and 300 IPOs, you've actually added a lot to the stock of public companies, which will then go on to continue in many ways. So we actually have created quite a pipeline of activity. If we look beyond IPOs, clearly some of those ex-SPACs and recent IPOs will come back to the market to do follow-ons, whether it's secondary or primary. And that means there's going to be a good level of activity near term. I think some of the banks are concerned that some of the economists, I think some of the banks are concerned that when we get through to maybe the first or second quarter of next year, we will see, rather than just the Fed having slowed its bond purchases, it will actually be subtracting liquidity from the financial system. And that's when, this whole discussion about excess liquidity in the financial world we'll see like what impact that has on valuations, and we'll see how much of the big high valuations we've seen in a lot of sectors, how much of that is really has substance to it. At the end of the day, valuations have to be back to earnings. We've also had some big quarters of corporate earnings, so I think we're looking at 30-40% EPS growth for the last quarter, and these sorts of numbers are very difficult to repeat and go into a higher rate environment. But as again, clearly there should be some pretty good economic growth next year. So, and there is also a number of high profile companies that we haven't seen come to market yet, which could go public near term, and names like Instacart we didn't see this year, which was one that was touted earlier in the year. Stripe, which was probably going to be a direct listing, which is a very large unicorn. That's one that we still haven't seen what their plan is, but that might be a direct listing. And then AIG is looking to, maybe something not quite as exciting, but AIG is looking to take their some of their life businesses public, and then also Bosch and Lomb is looking to take a few of its businesses public as it looks to delever after a tough sort of 5 years or so. But yeah, there seems to be, I don't think the bankers are really worried that there's a lack of companies around that they can take public. But it's just a question of if valuations come down materially, then it's not going to be as attractive to bring as many IPOs. And then some of the more marginal stories are going to be difficult for people to get excited about.
Well, a very interesting year for sure, and one that will set up nicely for when we meet again next year to look at how Q1 and Q2 are shaping up. So, Anthony, thank you so much for joining today, and look forward to seeing you all next year as we continue to watch this ever evolving equity capital markets in the US.
Thanks, Matthew. Thanks to ACG.